All right, let's get right into it. There's something really weird happening in the uranium market. You've got massive production cuts, you've got soaring demand for nuclear power, but prices are actually falling. It just doesn't make any sense, right? It flies in the face of basic economics. So today, we're going to follow the data and see if we can uncover the truth behind this market mystery. Okay, so this is the core of the problem, the central paradox we're looking at. Economics 101 tells you when supply goes down and demand goes up, prices have to rise. But look at this. In November of 2025, the uranium spot price actually dropped 7.5%. So what in the world is going on? Now, if you ask around, if you listen to the chatter, you'll hear this one simple story. It's the easy answer: excess supply. The idea is that the market is just being flooded with uranium from all these hidden stockpiles and secondary sources. It's a convenient narrative that seems to explain everything. But here's the thing about that easy answer. The moment you start digging into the actual hard evidence, the whole story completely falls apart. And that's exactly what we're going to do. We're going to follow that evidence and see what's really happening. So let's officially kick off our investigation. We're going to treat this just like a case file, and we're putting the most popular theory on trial. And here is our main suspect, the excess supply narrative itself. This is the theory we're putting to the test. The claim is that there is just so much uranium sloshing around from places other than mines that it's just crushing prices, no matter what miners or utilities are doing. Let's see if that actually holds up to scrutiny. Okay, time for the cross-examination. We're going to take this narrative, we're going to break it down into its 3 core claims, and then we're going to test each one by one, against the cold, hard facts. So let's start with claim number 1. This is the most basic one. The idea that utilities are just sitting on these huge mountains of inventory. I mean, if there's an excess of supply, their stockpiles should be bursting at the seams, right? Well, the data paints a completely different picture. Take a look. Sure, East Asia is sitting pretty, no doubt about it. But the United States, and this is the world's biggest market, mind you, is in a critical situation. They are running on just 14 months of inventory. That is way below the industry's safe level of 24 months. We're talking a 42% deficit. It's so bad that the U.S. Energy Secretary is calling for an urgent expansion of the country's strategic reserves. You just don't do that if you're drowning in supply. So right out of the gate, the claim of overflowing inventories is literally the opposite of what's happening in the world's most important nuclear market. Test number 1, that's a clear fail. Okay, so claim 1 is busted. What's next on the list? This idea that so-called secondary sources, government stockpiles, reprocessed materials, are all of a sudden just flooding the market? Yeah, this timeline shows the real trend. And again, it's the total opposite. Far from flooding the market, secondary supply is actually drying up. It makes up a tiny and shrinking piece of the pie. You know those huge post-Cold War programs like megatons to megawatts? They're over. Done. Governments are now building reserves, not selling them off. This source is disappearing, not surging. The narrative needed a flood of supply from these sources. The data shows a drought. So that's another decisive fail. 2 for 2. All right, now this is a big one. You hear this one all the time, that there are millions and millions of pounds of uranium that can be cheaply reprocessed from old mine tailings. And okay, technically, yes, there is uranium in there, but the key question is it actually economical to get it out? This chart really puts it all into perspective. At a spot price around $76 a pound, most of these tailings operations are just losing money. Their break-even cost is often way higher, like $85 or even $95 a pound. So the tiny little sliver that is economical, maybe 3 to 5 million pounds, it's a drop in the bucket. I mean, it's nothing compared to the 20 million pound production shortfall from just one major producer or the 31 million pounds of new demand we saw in November. Tailings can't even begin to fill that gap. So this whole idea that a flood of cheap uranium from tailings crashed the price, it just doesn't work. The economics are completely upside down. Test number 3 fails. Okay, so the excess supply narrative is not looking good at all. It's falling apart piece by piece. But now we get to the smoking gun. Let's forget all the stories and all the theories for a second, and let's just follow the actual physical pounds of uranium. And there it is. In November 2025, you add up everything, all the available supply from production, from secondary sources, from those economical tailings, you get about 29 million pounds. But then you look at the demand side, from utilities and other buyers, it was over 31 million pounds. The math here is really simple. More uranium was wanted than was actually available. The market was in a physical deficit, not a surplus. And this brings up a really crucial question. If the physical market is this tight, then what are the most informed, the most sophisticated players in the game doing? Let's take a look at the SPUT Physical Uranium Trust. These guys arguably have the best market intelligence on the planet. Get this, while the spot price was falling that 7.5%, SPUT wasn't selling. They weren't sitting on their hands, they were buying. And not just once. They made 6 separate purchases, scooping up over 500,000 pounds of physical uranium. This is not some opportunistic one-off trade. This is a systematic buying campaign. And this quote from the source material just nails it. SPUT's behavior screams scarcity, not abundance. You just don't buy that aggressively over and over into a falling market if you think there's a flood of supply about to hit. You do it when you believe the physical material is actually scarce and that falling price is just a temporary glitch, a dislocation from reality. Okay, the evidence is in. The case is pretty much closed. So let's lay out the final verdict on this excess supply narrative and then take a quick look at what might really be causing this strange disconnect in the market. This scorecard says it all. The narrative predicted abundant inventories. Reality showed they were critically low. It predicted a flood of secondary supply. Reality showed it was declining. It predicted a market surplus. Reality showed a physical deficit. It predicted the smart money would be running for the hills, but instead they were buying hand over fist. On every single count, the narrative completely fails the reality check. So if it's not excess supply, then what is it? Well, the truth is likely a mix of more complicated factors. For one, the uranium spot market is very thin, meaning just a few small sales can have a huge impact on the price. It's also possible that some really big, sophisticated buyers are strategically pushing the price down to give them an advantage in long-term contract negotiations. And finally, it might just be that the wider market hasn't woken up yet to just how incredibly tight physical supply has become. And that brings us to the final and really the most crucial point of this whole analysis. After walking through all the evidence, you're basically left with a choice. So which reality do you trust? Do you believe the simple, convenient story of excess supply, which means you have to believe that prices will stay low and that the biggest, smartest uranium buyer in the world is making a huge mistake? Or do you trust the data that points to critical shortages, a physical deficit, and a spot price that seems completely disconnected from the actual reality on the ground? A reality of scarcity. The evidence seems to point clearly in one direction, and it leaves us wondering not if the price will correct, but when.